guys. Let's get started. Hey, quick question for Ben. What's your minimum and maximum lend right now on the Gator side?
I mean, I guess I've never really put up a limit just because I have other partners that go in on deals with me. But I mean, yeah, I guess I've never thought about a limit. I mean,
I just put a picture or a text inside the chat. Take a look.
Let's see.
Gotcha. Thanks, Eduardo.
Okay. Whose chart is that or what?
What's that?
Who put that picture up or
in the chat room? Somebody,
yeah,
Eduardo put
okay.
the rates. Gotcha. Is this whose rates is this?
I think it just the Gator tribe's been putting up for like people that just need some direction. I don't really use a chart or anything. Every deal is different for me, so I just go off of the deal. And
this is
that's
typically
Carlos
an
was
idea.
saying. What Carlos was saying. Hey, what's the deal worth to you? I'll take money and equity if I can get it. But it's just that's just a guideline for people that still are trying to get their feet wet or don't know how to negotiate or just go off of a chart. So yeah, I guess it's just some people need like direction that way. I just go with whatever I can get.
Okay. And then as far as your maximum lend time, what's 30 days, 60 days, 45 days? What is it?
Right now I'm trying to stick to 60 days or less, but again, everything is I'm always open to seeing, the deal and everything. It just depends on the deal and how the deal makes sense and who I'm lending to too. Who the jockey is, like Carlos would say.
Yeah. Gotcha. Cool. Awesome. All right. Well, everybody, happy Friday. Sorry I haven't been here for the last 2 weeks. I was in LA last week for an event and I had a headache the week before. So appreciate you guys all jumping on today. It's been a while. Miss you guys. We got some new people in here. So hello to the new people. If you guys haven't checked the side of the chat room, I dumped 3 links in there. If you guys want to go check it out. If you guys don't see it, let me know and I can repaste the links for any of the new people that hopped in after I pasted it. So if you guys don't see it, let me know and then I can repaste it in there.
I don't see them. Maybe because
Okay.
I just came in not too long ago, but yeah, I only see the one from when Eduardo posted the rates.
Okay, cool. So I'm gonna paste it again. If anybody else jumps in after we start doing the live, do me a favor, just copy and paste those links and share it with them for me, because I won't be really checking much of the chat room because I have to share my screen. So, all right, so let's get started. All right, if you guys look at the link, one of the links have a resource is all the resources I typically use to kind of validate what my research is and any websites that I use to do any findings for multifamily homes. All right, can everybody see my screen up here? Yes, no? Can everybody see my screen?
Yeah.
Okay, cool.
Yep, looks good.
Yes, sir.
Awesome. So here we go. If you guys see that screen, multifamily resources, really quick, 3 websites, Crexy, LoopNet. These are free. These are what I primarily use. It's you can sign up and get an account today. CoStar is very popular resource, but it is subscription based. It's very pricey. That's more for people that's already been in the business for a while, or who are like in the commercial brokers. Typically, I believe like if you're not on a team, I believe they charge anywhere between $1,000 to $1,500 a month. But if you're on a team, it's like $400. So it does get pricey, but it's the best data when it comes to commercial assets. It's basically like the MLS for commercial real estate, because we don't typically have multiple listing service like we do if you're a realtor. But anybody can subscribe for these products. But recommended Crexi and LoopNet, these are your free ones. Okay. If you just go down the list, crimegrade.org. This is, if you're looking for a multifamily, you always want to check the crime grade around any city, because that will help you determine whether the area is a good area, or if it's because that does affect the value of your property, especially with people that's renting the space, especially with families. They want to make sure that their kids are safe in the area when they go to school or when they travel and whatnot. Geocoding system, you can just check out that link. It's a very, very useful tool. You can see a lot of data when it comes to any of your states, cities that you're looking into. It does help financial institutions to meet their legal requirements to report information on mortgages, businesses, and farm loan applications. One of my favorite websites to check rental rates, rentometer.com. It's a free website as well. They give you like 5 free reports if you sign up. It is free. You don't necessarily have to pay, but if you are, looking to compare rental rates for any, you can use it for multifamily, you can use it for single family homes. I think it's one of the better websites to use. There is also apartments.com for rent.com, apartmentfinder.com. You can also use that to compare rates, but I still find that Rentometer is probably one of the better ones you can use. These are their promo codes on the site. And then all these right below is just pretty much giving you like map tools, population for the specific areas, because in multifamily, we typically like to look for average base income for what families make, but also we want to check to see how dense the population is within that area of your the target market that you're trying to get into, right? And then also what kind of schools are. These are like pretty much your typical resources that you would look for in any real estate investment. You always want to check all these above. Cool. So these are your multifamily resources. Save this link, save it to your computer, or upload it to your Google Docs on your Gmail. All right. And then I also gave you guys an underwriting deal analysis 101. This is very long to go through. I don't necessarily want to go through it one by one, but this is a great resource to look at, how to find deals, what to look for in a deal. Some of the definitions that we look for as far as target metrics, like your typical IRR, equity multiple, cash and cash. Like some of the terminologies in commercial, you're gonna need to know, because when talking to brokers, if you guys are gonna go that broker route, you're gonna want to know the terminologies, because brokers and agents can sniff you out if they can tell that you're a newer agent. They're very, very direct in commercial space, if you guys have noticed. And if you haven't talked to any agents, you will find out. They get straight to the point. They don't like to waste their time. It's not like your typical residential agent where you can ask around like, hey, what's the story on this? I mean, you can ask what's the story, but they don't like to lag on the questions, right? The less questions you ask, they kind of almost assume that you should be doing your own due diligence with what they have provided. But the more questions you typically ask, they tend to get a little bit impatient. Not myself, but there are brokers out there that do. Let me see. Let me find, where's the resource one I'm trying to look for? Give me a second. Trying to find one of the. Oh, here we go. I'm going to share one more. This one. I'm going to share this one also. These are like your very basic commercial terms you should know. Let me find out where my chat room is. And this is my last link that you guys can take a look at, save it to your computer. It goes over basically what's an NOI, your net operating income, what your cash and cash return is, which is basically your return of investment. It does give you like your breakdown of how to write the formulas or how to do it on the back of the napkin type of calculation, what your cap rate is, what's a debt service coverage ratio. You'll hear that a lot, DSCR, or they call it DSR, debt service ratio. Price per square foot, price per unit, building classification. There's class A, B, C. Sometimes you'll hear a class D. And then your type of leases, right? Full service lease, triple net, modified gross lease. There's another one called full service gross lease as well. All right, so those are the 7 you should know, and there is a bonus down here. Commercial real estate is a relationship-based business. So when you go out and network, when you go out and call brokers and agents, you want to build that relationship over time, because they're the ones that actually are going to help you find the properties for you. If you're not going out there having wholesalers bring you deals, brokers, they're already out in the field. They're continuously making calls themselves, trying to, acquire properties for their listing. So they're a great resource. You should make friends with a lot of them. And if you don't have at least, I would say 20, 25 minimum in your phone, you need to start making contacts. Okay. Commercial, like I said, it is a relationship-based business, and you have to go out. I mean, real estate in general is a relationship-based business, right? And if you're an introvert, it's okay. I'm part introvert, I'm part extrovert. Some days I feel like, I just want to sit there and chill by myself. But some days, when I'm out and socializing, a bit of extrovert. But for the people that are introverts, the best thing, and I'm sure there's a few of you in here, the best thing to do is, get uncomfortable, start going to small little meetups, get into space. There's a lot of social networking events within your city. And if you don't find them, there's websites out there that, like Eventbrite, you can go meetup.com, find those networking events and go to those events to create relationships and tell them what you do. All right, you can go to seminars, you can go to conventions, many ways to get business. Facebook groups, I mean, that's one of the ways I source business, is I go into different Facebook groups and I sign up, and I literally just leave like what my buy box is, and I leave my email, and that's how I kind of get a lot of my deals is, they send me deals based on what I put in my buy box. So that's just a basic understanding of how to, build relationships, how to create business for yourself, how to get leads in the commercial space. All right, so what you're seeing here on the screen, does everybody have this in front of them? Powerhouse multifamily template?
Yes.
Yep.
Awesome, great.
Hey, I just got a question real quick. I got to
Sure.
run in a minute. Is this going to be put up on the YouTube? I've been looking forward to some of those, but the last couple of weeks they haven't been on there. The last couple of weeks hasn't been uploaded. Not just you, but just
We've just been slammed since we're doing our own media. We're doing our own
Okay.
media content, so it's just been slammed. But we are releasing a lot of the videos that haven't been posted in the last 2 weeks.
Okay. All right. No, I was just kind of checking because I got to bounce. I want to stay, but I can't because I got some other things I got to take care of.
Cool. Yeah, we'll be post. I know a lot of other people asked me the same thing too. I just told them, yeah, just give us a second. We're just trying to breathe for a second. We'll get them out there.
All right. Cool. Appreciate it.
Cool.
All right. So if you guys, everyone sees this, so this is a multifamily calculator that we built for the Powerhouse team. Don't share it outside of the group, please. This is for you guys primarily. And this is a pretty advanced calculator. Simple for me, but advanced for you guys. There's a lot of formulas in here that is a little bit more complicated than your basic spreadsheet that you've probably used, but this gets the job done. So just to help you guys out, anything in the blue that you guys see, anything in the blue right here, you guys can manually enter numbers, any number you guys want. Don't change any of the formulas in the black. Anything in the black, they're formulated for a specific function. So don't go changing any of.
Can you zoom in just a tad?
There we go. That works? Is that better?
Is that good, guys, or a little bit more? You guys cool? You'll be able to see everything?
Yeah, no, that's good.
Yeah.
It's better. Okay. Cool.
For the people that says they can't see it, I hope you're on a desktop and not on your phone. So if you guys are on your phone, that's fine. But yeah, so I'm just trying to make it a little bit compact because my screen is I have a wide screen, so it's a little bit too big for me. But here we go. So use this calculator to help you guys out on underwriting any deal. This template is basically an assumption. Everything you guys see here from year 1 to year 11, these are all assumptions, right? When we underwrite any multifamily deals, we kind of base it off of income, but typically there's some properties that are vacant, right? So you can't really typically underwrite a property that's vacant if they don't produce any income. So how do you comp a property that doesn't have any income? You go by per square feet, right? And how do you find comps? You use those websites I gave you, Crexy and LoopNet for the free ones, and you just base it off of the per square foot and what they were sold at. But this calculator is very, very advanced. All you do is really just plug in the numbers that you typically need. I've plugged in what our metrics are on what we use when we look for deals, right? So I'm just going to base it off of $1 million right now, just for examples. Okay. All right. So based on a 6 unit right now, because I have it all the way on the right, it's a 6 unit. This is just an example. So it's not like a real data as far as what we're going to use. But let's say it's six rooms, 500 square feet. So in total, there's 3,000. It gives you basically a denomination of, per square feet or a price per unit of 166,000. This is a rentable square feet of 3,000 total because it's 500 square feet. And price per square foot would be about the $333. It's already given us metrics based on a going in cap rate, but we haven't plugged in any of the expenses, right? So those are all going to be on the right side of this this spreadsheet. Everything on the left is just more of like your basic plugins, what I typically like to start off on. So if we're just kind of going down the cells in each column, you're going to type in your operating income, any other income right here. Your annual expense growth each year is going to be growing by, example is 2%. Any capital budget is basically what your capital expenditures are. You're going to hear that a lot. CapEx and capital budget, same thing. What are you going to be using? How much of the amount you're going to be using towards rehab costs, right? So let's say we're going to put in 150,000 to get things fixed up. We're going to start a renovation within 1 year, and it's going to be completed within 1 year. You can change it all the way up to 11 years. But we're just going to use 1 year for default. 1 year for default. Your capital reserve, this is going to be based off of your gross potential rent. So if I put 5% in here, it's already going to give me 707 because we have 1178 rental income on the right. So if you're wondering why that 707 popped up, I added a new feature on here. If you guys had this in the previous weeks, I'm always consistently updating this for new stuff. So before I didn't have the loan type, but now I've added this in the calculator where you can choose if it's an amortized payment, which is your standard traditional lending option, right? But then sometimes a lender says, hey, we can do interest only. Now you can change it to interest only, and it'll change this side of the spreadsheet where it goes 0 on all your principal payments, and it'll just go interest only. So I added that feature. Typically right now, commercial lenders are being very, very conservative with their lend. Before the market shift, they were lending around that 80%, 75%. Now they're lowering it down to 65, 60, 55%. So, as market rates keep climbing, lenders are getting a lot more conservative with their loan rates and their loan to values, loan to costs. But 65% is just kind of where I default all my underwriting at. Okay. Loan origination fees, typically about 1%. Interest rate right now for commercial lends, it can range anywhere between 6 and 9%, depending on who your lender is, what type of lending constraints that you guys are using, or, there's loan to cost, loan to value, there's DSCR, which is that debt service coverage ratio. And then they're also doing by debt yield. Okay. Amortized payments, I believe most lenders typically do 25 years. If you find a property that does seller financing, obviously you can negotiate your amortization rates, terms, but typically about 25 years is where lenders right now are going for. They want their money back a little bit quicker. And then your sale information, exit cap rate. Your exit cap rate is determined by your market, right? Every market is very different. And then every class is very different, right? Typically for a class C property, which is what you'll hear a lot in the multifamily space, class B, class C is what us as the investors, not institutional, us investors, for multifamily, if you're just getting started or if you're a veteran in the space, class B and class C is what we typically go for, because there's more value add components with with class B, class C versus a class A. Class A, that's where private institutional money and then hedge funds are going after. They're the ones that can park their money into an asset for 2%, 3%, 4% cap rate, right? For us investors, we want to maximize our returns, so we want to go for a higher cap rate, but that doesn't necessarily mean that it's a great thing. Cap rates, it varies, right? The higher the cap rate is typically means there's a higher risk in the property because of, the type of condition that the property is, where the property is located, what submarket it is. There's a lot of variables when it comes to the cap rate, but the higher the cap rate, when you start entering like that 7.5 up to like 12, 13%, that means there's more risk to the investors. The lower the cap rate, which is our incentive, we try to get a high cap rate and then stabilize it down to that 5.5, 6.5%. That's when you can start sliding that scale of a cap rate basis. And then here, cost of sale is when you want to exit, like if you hire a broker or an agent to sell the property in assumption that you're going to be selling it for 2%, 3%, and whatever year that you decide to sell it off, right? Right now, investors typically like to hold the property for about 5 years average. I mean, you can go up to 10 years on here or 11 years, but if you're going 10 years, obviously most investors right now, they don't really want to hold the property for 10 years, but institutions do, because like I said, institutions can just park their money and let it sit, right? That's their whole entire business model. For investors that like to hold for a shorter period of time, 5-year mark is about the average time that they want to disposition a property. And then this is our target metrics that we're typically using right now. And when I'm talking about us, I'm talking about the Powerhouse Capital Partners, which is me, Carlos, and 3 other guys that he put on together. This is where we're kind of putting our target IRR is at 15%. Our equity multiple, which means how many times can the property is how many times over will your investors make that money from your initial investment, is 2 times. So if you invest 100,000, you're expected to make at least double that over the time of the investment, right? Is 2 times multiple is what our target metric is. And then our leverage cash on cash return is 10%. Okay, leverage means if you're using debt, right? If you're going to see that on the spreadsheet, and you're going to ask yourself, what is the difference between unlevered debt and levered? Unlevered just basically means if you're buying the property without any funding, if you're not using any leverage, you're not using any lenders, you're just buying straight up cash. That's what unlevered means. Okay. Any questions so far? Nope. Okay. Cool. So that's just a basic understanding for how to use this calculator. Hope you guys find it helpful. I know there's a lot of things in here. It's probably going over your head, but the more often you come to these Friday classes, the more you're going to learn. It's not an overnight thing. It took me a while to get into an understanding of how to run these numbers, what type of metrics to look for and whatnot. But as you know, as you keep listening to YouTube videos and other underwriting classes, you'll eventually understand it. It's all just terminologies at the end of the day. It's like real estate, residential real estate, right? You don't just go into a sector without having to learn something. So the more you come in, you practice and spend time in it, you'll eventually understand it.
I have
It's
some
definitely
questions.
sure. What's up,
Sorry
John?
to interrupt y'all.
Go ahead. What's your question?
Oh, hello. I'm just talking away. All right. Sorry about that. Okay. So so for multifamily, I see your sheet here. You have gross potential rent, and then it goes all the way down to positive, negative leverage. So if you can walk us through, a deal, like if you have a multifamily deal, at what point are you using this in the deal? And who do you show this to when you're going over it all? Are you going to show everybody in the party, or is this more just for your metrics and your numbers and everything? And how long does it take? I know this is loaded, but I'm trying to get you to feel where I'm coming from. To plug in all this information, when does this actually come completed, where you can actually rely on this and say, okay, guys, these are the solid numbers. Here's what we're presenting. Sorry about that. I know it's
Sure.
loaded, but I think you got me.
No worries. I got you. So basically, this is what we do more in the second phase. This is more the in-depth of once you have something, I would say, accepted on your LOI, your letter of intent. This is kind of more a deep dive on it, but this is more of an investment summary of the next 10 years, right? If you decide to hold the property, what is it going to give you an assumption? So I don't usually type these in from the start unless the numbers are already given to me on the financials. But I was going to go and show you guys what it looks like to start. Like, what is your phase one? I jumped into this just because this is more of like an in-depth, like to understand how this works. You basically want to sort out every deal and sift through it, right? It's basically how I can say it is, once you know that the deal is worth underwriting, because you're going to spend a lot of time, like an hour, 2 hours sometimes at doing this, because once you start doing this, it means that you're already in the deal and you're getting serious. You're going to have a purchase and sale agreement in place. But aside from that, if you just want to practice on this really just shows you a deep dive of what the property is going to produce, right? And let's say, for example, when you have the T12 financials, which means the trailing 12, they already give you the idea of like what is the current in place rent. So you plug it all in here on the right side where it says operating expenses, you type down all the unit mixes, and it gives you an idea of like, hey, is this worth purchasing based on the metrics that your targets are? Does that help? Does that answer your question for that one?
Oh, no, that answers it a lot. And you also answered some other key question. You said prior to writing the purchase agreement. So you're doing this before you're finalizing the agreement. And then secondly, when you mentioned the financials, before you get the financials and before they release that and you don't have a signed purchase agreement, are they requesting that you sign an NDA? I'm assuming because you don't even have a locked in agreement yet for you to see all of their financials.
Not necessarily. It's really a game of negotiations, right? There's some brokers or wholesalers that won't play ball. Some do, but typically like private institutional banks or private lenders, and even like some investors, they don't even typically send a letter of intent of an offer without even getting the P&Ls, right? Because you want to know what the rent rolls are. You want to know what the actuals are in place before you can submit like a pretty good offer. I mean, you can do a preliminary offer before your LOI, but it's really up to you and up to the broker if they're willing to give you those financials. And yes, there are times where they ask you to sign an NDA. typically for the ones that are more private, right, off-market deals. I'll give you an example. I was trying to negotiate like a large hotel financials from a wholesaler, but the seller side wouldn't allow us to get wouldn't allow us to get the rent rolls. And that's hard to give a preliminary offer when they were like, hey, just submit an LOI. For PE guys and guys like myself, we don't like to submit an LOI without knowing what the rent rolls are. It's kind of like you're going in blind, right? But sometimes sellers are just hard-headed just because they feel like you're going to be wasting their time if you're going to, they're going to send that information. But, who's right or who's wrong? It's really dependent on how good the deal is, that if you want to, spend more time on it. But most times, this specific window, I try to do this more in the phase 2 now. Before, I would spend a lot of time doing this on phase 1. But what I've come to learn from other underwriters in our group, we don't spend a lot of time on this until we even know if it's worth offering on.
Perfect, thank you.
Okay.
Yeah, I have more questions, but I'm not gonna hog the mic. I'll hit you on the back channel.
Sure.
Thank
Yeah,
you.
no worries. No worries. So how do we find out if it's a good deal or not? Right. This is where we use the reverse valuation. So this is what I meant to do on phase 1. Right. Phase 1 basically just says like, hey, is this even worth offering? Like, you're going to go through a lot of deals that you're going to have to sort through, right? Out of 100 deals, you're going to probably make 10 offers, and out of that 10, you'll probably get 1 accepted. That's how low of a hit rate commercial is, right? You have to send multiple offers, or you have to look at multiple deals, and by the time you get one deal accepted, is basically a 1%. But the more deals that you can underwrite, the more practice you get in, the more that you use this calculator, the more you get used to it, then you'll eventually find that rhythm and tell yourself, I'm going to spend 2 to 5 minutes on the deal. This doesn't work out. All right, on to the next one. So this is like your basic underwriting back of the napkin type of deal. I'm just show you right here in column B, right? All these blue inputs, 1, 2, 3, 4, 5, 6, 7 metrics right here. This is going to help you analyze the deal real quick. I'm going to show you real quick how and what I mean by that. So if you know what the market cap rate on the exit is for a specific property, like let's say, for example, I live in Nevada, I live in Las Vegas. Our market cap rate for a Class C property is 7.5%. Okay. The market vacancy that I normally plug in as a default is 5% vacancy. All right, so we'll put 5 for that. We'll leave other income blank because that's just more of like a backup column. Pro forma, you're going to hear that a lot. Pro forma means your future value of what you're assuming the rents are going to be at, like future value, right? So let's say, in place rents is currently at $600. And then in the future, after you decide to stabilize it, you repair the property, add some value, you can rent it up to $1,000, right? So you're going to increase that by $400. Now, in order for you to increase it to $400, you had to spend about, example, $10,000 per unit. Okay. And let's say there was 50 units. You see how it just calculated all of that without me having to do a lot of things. I literally just plugged in those numbers. Now, expense ratio. Expense ratio is determined by what your gross potential rent income is and how much of that you're going to be removing from your operating income, right? And what we normally do is 50%. This is like your default like standard. So with that being said, there's 95% occupancy, right? Your gross potential rent is 600,000 because 50 times 1,000 times 12, which is per year, you're going to get $600,000 as your GPR, your gross potential rent. Okay, minus vacancy of that 5%, you're going to get 30,000. Less that, you're going to get EGI, which is your effective gross rent of 570. Out of that 570, that's where your 50% ratio gets used, right? So 50% of 570 is 285. Now your NOI, which is your net operating income, is $285,000. Your total rehab costs is about $500,000, because if we take 50 units, we're multiplying that by $10,000 per unit that we're using for capital budget, right? Your stabilized income or your stabilized cap rate at 7.5% means that this property should be valued at about $3.8 million. Now you're asking yourself, okay, Stan, how do I go about offering on that specific property, right? Well, you look at right here, okay? Columns A and B, there's 3 different ways we look at commercial or any real estate, right? There's a value add component. There's a stabilized, meaning it's already been pretty much done, right? It's been completed, it's been added value, it's stabilized. And then you want to do a wholesale, right? A lot of you guys are in here more than likely wholesalers as well. So there's a wholesale column, and you're going to put in what your wholesale fee is. So if we look at the value add component, right, we use what's called a max allowable offer, which is our MAO of 2.16 million. And how do we get that? Well, you basically take your 3.8 million, you multiply it by that 70% all in, and you're minusing your rehab costs. And that's how you get your max allowable offer. So in total, right, your purchase price plus rehab is $2.66 million. And this is at 70%. So if you're about to make an offer on a property, this is what the metrics you should be looking at, and you can offer on. You can change any of these components, like I said, in blue, and it'll spit out a different output, right? So if we go 85%, your max allowable offer should be at 2.73. So this is like your first phase. If you really want to go real quick and sift through a lot of deals, you just go to this reverse valuation calculator and plug in these first numbers right here. And then you just basically reverse engineer, pick which one that you want to use. And that's where you're going to be submitting your offer. This is not like a guaranteed number that you have to go by. You can always adjust it. But, this is your fastest way of evaluating a property and not wasting a lot of time, looking at the expenses, going through the whole entire T12. And if it does make sense based on what they're asking, then make an offer, write an offer on it, right? Let me add this because I'm going to add this. It's going to be per unit, so everyone kind of knows. I'm going to add this right here. 76. Forgot to add that. Okay. So I'm just adding these numbers. This is going to be based on per unit, right? 76,000. And if you're going to do like the value add, it's going to be that. So I'll do it for this one. Oops. Do it for this one as well. And oops. Anybody have any questions so far? Does this help you guys out?
I have something to add. I mean, for the 20 plus people that are here, I will throw in a challenge and say, you guys should buy the multifamily book that Stan recommended a few weeks ago. I've been reading it. I'm almost at the end, and everything that Stan is saying that used to be hard for me to understand, it's super simple right now, because that book, it opens up. I would say it's just an analogy, like opening up the hood of your car and you have no idea what it is. That book tells you where the battery is, where the alternator is, where the windshield wipers are. Like, it tells you everything. So it makes much more sense. So I think you guys can buy the book. It's like $20 on Amazon and read.
Yeah, it's a really, really good book.
It'd be amazing, because like we're gonna come in more prepared to understand what Stan is talking about. Because everything that Stan is saying to me like 3 weeks ago was like, I have no idea what he's talking about. Right now, it makes so much more sense.
I'm glad you read it, Daniel.
Yeah, good stuff, bro. I have the Audible on that one.
Every day I'm reading it. I'm doing a chapter a day, and yeah, man, it's insane, because and the way the book is, it's like it's step by step. It starts from zero and it just keeps on going. It grows on you, and yeah, it's very good.
Yeah, Daniel left the book on the chat room. So if you guys want to look that up, it's on Amazon. It's written by Brian Murray and Brandon Turner, the host of Bigger Pockets. So to get the volume 2, because volume 2 is 5 units and up. Volume 1 is more of like the basic on, duplexes, triplexes, fourplexes. But if you really want to get into like the actual commercial multifamily, that's 5 units and above. Volume 2 is that book. But it definitely helped me out when I started. And I actually have it on Audible. So I just listen to it at the gym. I listen to it while I'm driving. But it's a really, really good book to go off of. Okay, so we're gonna use
And it's very simple too. The way it's written is very, very simple. There's nothing like weird or nothing that you have to like Google it or anything. It's very simple.
Yep, it goes in depth and it's really like your entry of starting and learning how to go about investing in multifamily. There's a lot of terminologies in there that they explain really well. Yeah, it's a really highly recommended book to get. All right, so we're gonna go through the formula cheat sheet tab. Okay, if you guys are still following along, the 4th tab to your right. This one is gonna be really simple. Like these are the formulas that you really want to just kind of understand, just for really basic back of the napkin type of formulas. It tells you exactly how I do it right here, right? Net operating income divided by cap rate. If you want to get your purchase price, if you want to find out your NOI, you take your purchase price, you multiply it by cap rate. That's how you get it. Your NOI divided by purchase price will equal your cap rate. So this already does it for you. I already have it all plugged in here, right? Remember everything in the blue, you type, right? So if I change it, I want to say it's 50,000 NOI. I want to get a 10%. I want to know what the purchase price is on a 10% cap rate. Boom, right there. It's going to be 500,000. If I want to know what the net operating income is for a property at 7.5%, my NOI is going to have to be 75,000 at $1 million purchase. Now, if I want to know what the cap rate is on, let's say, $5 million property, it's generating, let's say, 500,000 NOI, then there we go. Cap rate is going to be 10. So use these functions if you guys want to like understand how to use spreadsheets and you want to build your own. You can always play with it. Just look at how everything is written in these functions and it'll tell you what the formulas are. I've given it to you guys in here. So this is like your real cheat sheet of how to get about these metrics. If you want to understand how to do forced appreciations right here, this is a really good one. Let's go back to the example that I used earlier. If it's $600 on current in-place rents, I want to change it to a pro forma and I can bump up rents to 1,000, right? There's $400 in spread for 50 units at 95% occupancy rate, 12 months, right? Because it's 12 months in a year. That market cap rate is 7.5, right? In Las Vegas for a Class C. I've literally added over $3 million in value from creating that $400 spread. And that's why a lot of investors like to get into the multifamily space is because you can create value by adding, you can create more value to a property by increasing rents, right? And you're going to ask yourself, how do you increase rents?
I was reading a book this morning, dude, about like exactly what you said. And it said that every $100 that you can charge rent brings like another 1,250 to that purchase price. So you times that 100 times all the units and you can add it up like that. It's crazy. I was like, I didn't even know that. I was like, I didn't even know how they got that number down, but it was like off of like a 7% cap rate. If you just charged $100 a month more on like rents, that it off of, I forgot how many units were this, but it came up like another like 400 something thousand dollars just raising it up. And then I can imagine like bigger unit size complexes. I wasn't aware of exactly how much like it added. Like I know that you can raise rent $100 and the value comes up. I just didn't know exactly like how you can factor that in. Now I was
Yeah.
like, oh, okay. I started this after reading that book today. I was like, oh, okay, that's pretty clean way to explain it.
Yeah, or you could, exactly what you said, you could just use this, right? So if we change the metrics right here and you increase the 50 units by $100 only, right? It's $1,266 in increased value per unit, right? And that just added $760,000 just from increasing the rents to $100, right? Obviously, you're not taking into account any of your rehab costs for the first year if you have to put in rehab, and more than likely you're going to have to, because nobody's going to want their rents bumped up without having to see any changes in the complex, right? But this is the best way to do it, and it's pretty. I mean, you can't really do that with single family homes, right? You can do that in commercial. You can do that with shopping plazas. You can do that with storage units. You can do that with office buildings. Like, that's why commercial real estate is getting really, really popular, because if people are starting to understand that you can create value by just increasing rents, adding better amenities in the property, right? Adding a better laundry room. You can charge for that. You can add a dog park in there. You can add vending machines. Whatever it is to do with increasing the income of your property will generate a higher value of what your property is going to be worth. Okay. I'm going to give you, and then this one right here, loan sizing. This is more for kind of reverse engineering what a lender would lend on the property, right? Because you're going to want to know this. Let's say you're wanting to buy a property for $1 million, right? Appraised value, they tell you it's going to be $1,200, $1,200,000, right? Closing cost is going to be about $20,000 at 2%, and then you're going to put about $200,000 in rehab costs. Well, interest rate went up to 6.75, right? Amortized over 25 years. Year one NOI is about $10,000. Now, with all these, right, LTV right now is about 65. So loan to cost, let's say it's just going to be decreased to, let's decrease that to 60%. A DSCR, the debt service coverage ratio, you're going to see this. The standard lending amount is at 1.25 times your net operating income, right? So what I mean by that is your net operating income has to make more in your debt service, more than your debt service by 25%. Right? That's how they look at your metrics. You have your net operating income has to make more than your debt service. It has to cover it by a 25% more. Okay, so based on what all these metrics look like, it's going to spit out what your loan terms are going to be with your lender, right? At a $1 million purchase price, the loan to value at 65%, they're going to lend you at $780,000 on a loan to cost. It's going to be $612. A DSCR has to meet 1.25. It's going to have to be at on their interest rate. They're going to only loan you off of this. Well, this has to be a higher NOI. Let's see that. So it's 50,000. Then it's going to be 482, and then your debt yield, right? What they're going to have to make if they have to foreclose on you at 7.5%. This loan sizing is going to determine out of these four, what is the lowest that they're going to take, because what they're going to say is, hey, out of these four lending products, we're only going to take the least of these four. So it does it automatically for you based on the formulas. It's going to choose the DSCR because this is the least amount that they have to lend on your asset, right? So this is already, I have this created on here on this side of I added a little bit more columns. This is a little bit more in depth. I have to update that one in the back. But that's how lenders use the metrics when they analyze your property. That's why they kind of want to see the T12. They want to know what the rent rolls are, the actuals on the financial product, because you're going to have to submit that to the lender to give them a better valuation of what they're going to lend you on. An investor underwrites properties very different, a little bit different than what an actual lender looks at, right? We look at certain metrics and they do too, but they're a lot more conservative than when they have to lend, So they have to see those actuals, they have to see the financial statements, typically on a trailing 12 months, the last 12 months of year to date. And if there is missing numbers, and sometimes obviously mom and pops, they don't typically keep a professional P&L statements, they don't have a professional management company, property management company to track records, it's really hard to give a valuation off of that, right? I had another sub-2 student reach out to me today and asked me to help him underwrite a property, but it's, they gave us last year's statements from December 2020 to 2021. Obviously, we're already in October. And then any of the current financial statements, they were all, up to August, from January to August. So it's incomplete. So I said, find out what the full T12 is before you send it back to me, because there's, we're just going to be wasting our time if we don't know exactly what the rent rolls are, which they didn't provide either, right? A lot of times, people are going to start submitting deals to you and these things are incomplete. Well, you need the two main things, T12, your trailing 12 months of financial statements for profit and loss, and you also need your rent roll. Your rent roll determines every single unit that's in the property, tells you who's paying what their lease term start and end are, if they have any deposits in there, if they have any government assisted program that they're on, right? Any like Section 8 or any other programs, CHAP, for some states. And they tell you all that, or they should at least give you those basic info. Without those, it's really hard for a lender to give an idea of what they should be lending on your asset, because most of the time they're not really, a lot of the times these lenders, they base it off of what the asset generates. They don't typically look at you and say, hey, Carlos, what do you make? What's your W-2? That's the great thing about commercial real estate, is that they look at based on what the income is generating on that specific property. Okay.
That's awesome.
What's that?
I said, that's awesome. I saw somebody advertising that. All he kept saying is, you do not need to qualify. Multifamily is one of the easier ones
Yeah.
to get qualified for. That's all he kept saying. He said, please check into it. People check into it. I haven't really checked into it a lot, but it is something that I'm interested in. If you don't mind, I have a question for you, since I don't hear anybody asking anything. When you're saying that they need the T12 financials in order to qualify you, and it is based off of the asset, what do you do if you run across somebody, because I'm sure it will occur, somebody that has a multifamily, but they're terrible with numbers and accounting, and they kind of just give you something in Microsoft Word and they tell you, look, this is all I have. I can give you some statements and you guys need to figure it out, but that the property is of value. What do you do in that situation when somebody has messy accounting practices when it comes to presenting something to your lender? Do you pass it up? Do you kind of dig and get information based off their statements? What would be the process for that?
Yeah, good question. I actually had to deal with that today. So the best way to do it is try to get their tax statements that they've had the last 2 years, and just, you can kind of reverse engineer based off of what their income is. And depending on how many units that they have, right? You're just taking your GPR, your gross potential rent that they've accumulated over time, averaged the last 12 months. And you take that and you kind of have to just plug it into the calculator, right? And you kind of have to just ask them like, hey, who can, come up with a spreadsheet or help them out. It's really up to you. But that's the part that you're going to have to really do if you're dealing with direct to seller. Some, like I said, mom and pops don't typically like to keep good accounting. They're messy. So, but if you do find a property that is distressed that way, there is a lot of opportunity for mismanaged properties that don't keep good accounting. The hard part is really giving them a really fair and accurate offer. You're kind of just going off of estimate, right? And that's kind of where you fall on the comparables per square feet, right? There's two ways to analyze the property, right? Per square foot, per unit, and income based. More than likely, if a property is occupied, then you're going off of income. But if they don't provide the right financials, they don't keep good accounting, You're just gonna have to do your best you can and get an estimate. Get their paperwork, ask them like, hey, please provide me your water bill, your electric bill, all that sort of stuff, and just start plugging it in these columns. You really have to just reverse engineer it. And underwriting is it's part talent, but it's also science behind it, right? Now you have spreadsheets, you have Excel to help you really determine those. But you still have to do your own due diligence behind it. So if you want to do that, practice on smaller properties, right? Your duplexes, triplexes, fourplexes. What I would do, and what I always used to do, is I just go into LoopNet and Crexy, and I just find deals like here. I'm just going to give you guys an example. But did that help answer your question?
Oh, yes, yes, because
Okay.
you definitely don't want to do this just with a pencil and a paper. It sounds like you got to get everything and really
Yeah.
look at it. So that's now why I see your spreadsheet is definitely key and crucial, because there's too many aspects to multifamily. Like you said, all the bills, the taxes, and just all the tenants, especially a large unit. You know, people that are buying 800 doors and 900 doors. Like, are they using spreadsheets like this, or would that look different too?
So with 800, like, I mean, you're talking about big assets like that. If they don't work for a brokerage, then they're typically using a spreadsheet like this. Some people have a proprietary app that they've created within their, or they use a software. Big brokerages use a company called Argus. I've never used Argus, but it's what private institutional hedge funds use, and it has all their complex formulas in there that they just plug in. But, you know, this is the next best thing, right? Your spreadsheet.
Wonderful. Thank you. I appreciate your time. This is so golden. Thank you. And yeah, and the powerhouse. Thank you so much.
Yeah, you're welcome. So maybe we'll do some I know it's almost 4:30, but maybe we could do some homework for you guys if you guys plan on coming back next week. Keep this more of like a group interaction type of thing. Right now, what my group with Carlos and the 3 other investors that we're doing with Capital Partners, the powerhouse guys, we have our buy box, and you're going to hear that a lot, right? If you look at right here on column L and M, this is our buy box, right? They're going to ask you what, if you talk to brokers, what's your buy box? What's your buy criteria? What's your parameters? All right, this is our simple parameters, right? We look for Class B, Class C properties. We're looking for 10 to 60 units. In the Texas market, submarkets of Houston, Dallas, Fort Worth, San Antonio, and Austin, right? Price range around 50,000 to 100,000 per unit, which goes between like that 1 million to about $10 million price range. Okay, and we're looking for simply value add opportunities, right? We want to go there, and we're going to be the general partners, and we are the operators of the properties, right? And then we also want to look for at least an 8% cap minimum. And how cap min. So what I mean by that is when you're looking at deals on like Crexy and LoopNet, I've already done it right here, right? If you look at where I put multifamily for sale, it's Tennessee, right? If I go more filters and I punch in right here, cap rate, I can put whatever cap rate I want, but as of right now, 8% cap rate is what we're looking at to start. So it already does the filtering for us, and it tells us in Tennessee, right, everything is a minimum of 8% or more. All right, anything below that, pretty much people are already stabilizing it, and they're just there to park their money. We want to get the most value for the investors, so we want to go in and repair the roof, repair the units, you know, put lipstick on the pig, right? Add different amenities to the properties so that we can generate more income and cash flow for our investors. So this is kind of like the template of how we start. We just look for the, you know, we look for those metrics. I put Tennessee just because Tennessee is another great state for a landlord friendly state, and then also a state that doesn't have rental restrictions. Those are the main key things that when you want to look for any deals, right? You want to look for landlord friendly. I'm going to type this in. Landlord friendly states. right? The landlord-friendly states are Texas, Georgia, Tennessee, the Carolinas, and Florida. Those are the 5 main popular ones, right? And then you also want to find states that are, there's no rental regulations, right? What I mean, no rental regulations is that you don't want to invest in like a New York where you can only increase the rents by 1% every year. Like California, same thing. I don't know how much you can increase the rents, but they don't typically allow you to do that, right? So how do you maximize the rental income if you can't bump up rents from $600 and they're under market by 400? You can't. So you don't want to find, you want to find those states that these have these 2 factors in it. Okay. But let's do a little bit of homework. Before next week, do me a favor, go on LoopNet, go on Crexy, find the state that you guys want to invest in primarily, use the calculator and find a state, find a property, just one. You don't need to do a lot. Just find one property that you guys want to, that you guys are going to underwrite yourselves. Use the calculator, right? Like for this one, I clicked on this one earlier, the Beaumont State. And I was just kind of reading the overview. This is what we call an OM, the offering memorandum. So you're going to see this and you're going to see all the information that the broker put together on this memorandum sheet. This is basically like a pitch deck for any investor to look at. It gives you a lot of information that they want to disclose. So most times they'll let you see the operating income, the pro forma that they're expecting, right here. You can literally take this, the current rents or the current numbers, and plug this into your calculator, right? The taxes, insurance, utilities, and all that. Yep.
Sorry, I just want to ask you a quick question. So I'm actually looking for some properties for someone. And one thing that they've told me is that they want $1 million upside or like $100 of organic rent raise. So it's an instant value add. Would I be able to do that just by doing that back of the napkin underwrite with this information from the OMs?
Yeah. So you literally, so in order for you to do that, right, for that $1 million, you can use that under force appreciation. So if you said a $100 upside, or $1 million, you said $1 million upside, right? So
yeah,
I'm assuming is it the Texas group?
yes.
Yeah. So for Myron and Joseph Mudd's group, I know they're buy box, right? So you really just plug in the numbers. So if it's like a 40 unit, you're just basically reverse engineering that, right? So how do we get $1 million upside if it's a 40 unit? Well, what can they bump their rents up to, right? It depends. What is their in-place rent? So if their in-place rent is $800, you can bump it, let's say $950. Okay, so that's not $1 million yet. Let's say 975. Boom, right there. You can even do 965. Let's see, right there. That's the closest, right? So you can bump it up $165, and it tells you how much upside it's going to give you.
As long as the market supports that, right?
Correct. So you have to know what the market cap rate is, and I believe their market is Houston. Houston's
No, it's actually Marcel and Trevor.
okay. Yeah, so just find out whatever state that you're diving into, just find out what that market cap rate is, right? And you just plug these numbers in.
Is that usually standard across the board? Like I'm looking for properties in Florida, so what's the standard?
It's not really a standard. You got to find out from a property management company or talk to a few brokers and ask them, because every area is different. But I would say if you really want like an average number, Class C is about 7.5 to 8.5%.
Only Class A or B.
If it's Class A or B, then you're looking at about that 5 to 6.5.
Okay. All right.
Yeah. So
perfect.
if it's so just plug it in here. Just use the blues, but you have to know what the in-place rents average is, and then you have to know what the market rents can go up to.
Got it. Okay.
Yeah.
Perfect. Thank you.
You're welcome. So going back to this the homework I was gonna tell you guys is, if you guys want to do this, and then I'll ask for a volunteer next week to see which one is that we want to fully underwrite. But like I said, the OM will generate and tell you all your current in-place rents and what they're suggesting as their future rents for this property, right? It gives you all the investment overview. It tells you exactly like what they've done to the property. Right, the last 36 months, they've done all these repairs. Right, this is $139 below market rent. So it kind of gives you a summary already. Like this is the type of property we would look at, we would consider. Just kind of off the back. Obviously, we haven't plugged the numbers in, but this gives you an idea of, hey, is this property worth it? You can just plug all these numbers in, play with the calculator, and spits out a number for you. All right, I think that's that concludes today's class. Does anybody have any questions? We'll leave it as an open floor right now. If you guys want to ask me any questions.
I have a question if nobody's gonna ask one, or I'll go to the back of the line. I feel like I've been just doing all the talking.
It's all good.
All right, well, okay, let me shoot for it. All right, so can you go through, if we're making an offer, let's say on multifamily, or let me back it up. Okay, to qualify for multifamily, that's probably the better question I want to ask you. When you said that there's limited information, in your opinion, what is it that someone's going to need? If I wanted to go buy multifamily tomorrow, I've looked at the T12 and everything looks good and I'm ready to qualify. What do I need if I'm going to say purchase, I don't know, a $200,000 multifamily and I'm ready to go? What would be the minimum?
Well, you just got to know what your loan to value is, right? You have to qualify with your lender to make sure that, hey, I have these things in place. So, I mean, 200,000, that's probably like a duplex, right? So duplex doesn't really qualify for a commercial lend. That still falls under residential lending, right? 4
Okay.
units and under is always residential lending.
Well, let's raise
So
up the price then. Let's raise it up to
Sure.
900,000.
Okay, so let's say it's 900,000. You have things in place, and are you planning on, how are you looking to fund it? Are you trying to get like a bank lender, or are you trying to get private lenders? What is your objective?
The objective would be to, I would hope that it's, fully occupied, but whatever would be the most advantageous option. So what typically are the best options when you're a first time buyer purchasing multifamily? What would you suggest to go for? What's going on in the market with that? And
Right.
just from your perspective would be great.
So for us, I mean, we typically don't want to use our own money. We want to leverage other people's money, right? So like we're taught, if you want to have the less risk, you find somebody that has private capital to lend. Okay, so if let's say you have a $900,000 property. Hey, let me use the calculator real quick. Where is it? There we go. So if we have a $900,000 property, let's say example, it's a 10 unit. Okay, let's keep this at $1,000 for rent. So right now, if we're gonna look at that, right, we know what the commercial lend terms are, right? Loan to value is gonna be 65% on a $900,000 purchase price. They're gonna lend you around that $585,000. So you're gonna have to come up with the down payment difference of $315,000. Now you're gonna tell yourself, hey, I need to put, let's say $100,000 in this property. Okay, so now you're gonna take that 100,000 plus your down payment of $315,000 plus your closing costs. Remember, there's those three, right? So your total investment in this deal is $397,000. Okay. You take 315, you add 100. I'm sorry. Hold on. I messed it up. 100,000. Why is it doing that? Oh, I'm sorry. Yeah, so you add all those three together. So down payment, closing costs, plus capital budget, it's actually $433,000, right? If you take that number, you're gonna have to find this as a private money. If you go the private money route, this is what you're all in and for into your property of $900,000. That's if you're gonna be putting capital budget, but let's say it's zero. Now you just have to find 333,000 to put into escrow once you guys are ready to go. So that's like your best scenario if you're gonna use leverage. And without using your personal money in the deal.
Okay, that makes sense. And my final question, I hope it's my final, something will always pop in my head. Earnest money deposits. Typically, how does that work for the multifamily? At a minimum, what are they going to ask for and what we should be looking for?
1 to 2%.
Okay. All right. Thank you.
Mhm. Cool. Anybody else?
I actually do have a question. I have a guy in Kentucky that's selling, he's trying to sell 11 of his properties, all as like a portfolio. Can I use this calculator on something like that or no?
On the portfolio,
Yeah.
if you add all the numbers together, sure.
And is that something you guys would be interested in as well?
Probably not. We don't do portfolios unless it's like, is
Okay.
it all multifamily?
It's not multifamily, it's all Section 8. So
Yeah, then no.
Yeah, no.
We're just looking for multifamily. If it's like a portfolio multifamily without any SFRs, then we'll probably consider it.
Okay.
As long as it
It
hits
takes a
our
long
buy
time,
box.
right? It
Yeah.
takes a long time to underwrite a portfolio of single family homes, and it already takes a long time for multifamily. Can you imagine, 50 single family homes that you have to comp individually? So it's like right now we're just focused on this portion at the moment. Maybe who knows, down the road we might, maybe we never will be. But I know that the multifamily, the commercial zone as well is what we're in. Not really too much at the moment on portfolios.
true.
Cool. Anybody else?
You guys got some value? You guys learned today?
Yeah, man. Yeah,
Oh,
man,
yeah.
it was amazing. Hey, Stan, I
Good,
have a question.
nice.
So what second book would you recommend?
What is the other book? Does it have to do with real estate?
I don't know. I mean, it's commercial, but yeah, I mean, whatever.
Well, if it's not having to do with real estate, I would say the Ed Milet book, The Power of One More. That's a really good one that I just finished a few weeks ago.
I think
but if
he
you go
wants. I think they want commercial, right?
commercial.
Yeah.
Yeah, commercial. Yeah, the power of now. I listened to it on YouTube. It's amazing, that one as well.
This one is what I would get.
That guy Brian
Confession?
Murray, whatever. He has
Yeah.
another book called Crushing It in Apartments and Commercial Real Estate. That one's a good one. And then if you guys want
Okay.
to learn something simple, they have the Commercial Real Estate for Dummies by Peter Harris, and his other partner Peter something. That one's a really good one as well.
Cool. I'm studying a new one, Raising Private Capital, also by Bigger Pockets.
Yeah.
Oh yeah, I just read that book.
Yeah.
Alf sent it to me. He had like gifted it over to me, and I read it in a few days. It was nice. It's really good.
Yeah, no,
Learned a
because I
lot.
signed up for the Gator. And one of the books that he recommended was that one. So I'm getting
For
ready
sure.
for that.
For sure.
There's
Raising private capital is like lead generation. You got to go out there and do it.
yeah, so in the subject of raising private capital, there's an app that just got released as of this week. It's created by a guy named Chris Noggle. It's called the privatemoneyclub.com. So if you look up privatemoneyclub.com, it's basically an app that is like Tinder meets private lenders together. It's freaking dope because
Bro, it's the
you're-
sickest thing.
Yeah, it's such a genius app. They just released it. It is a membership. It is a subscription base. I think they raised it up to like $14.97 today, but you're locked in for that price for the next 3 years, and they're going to keep raising the price eventually over time. But it
Yeah.
basically connects you with a private lender. You're basically swiping through the deals in your state. I think they've released 37 states so far. 13 they're working on being able to upload. But if you're a lender and you want to lend money, you can use that app. If you're a borrower, that's a great app to find private lenders. From what I heard on the live
Yeah.
event, they were able to raise up to 30 million just on one deal through that app during their beta
Jeez.
phase.
Bro,
So
it's like an investor lift, but just for
Yeah.
lenders. Dope.
right. And it's actually a really, really affordable price. And you're not having to go out there I mean, you're obviously still having to create relationships with these lenders, right? You still want to do your due diligence and whatnot. But, it's a great app to use if you guys are trying to get private money. Yeah,
What is it
TTP.
again? Privatemoneyclub.com?
Yes. It's literally like a dating site for private lenders and
It's a
borrowers.
Tinder site. Yeah, for lenders
Yeah.
and borrowers. It's badass.
Swipe to the
Swipe
left
or
and
right.
right?
Yeah,
Oh my
you
God.
can
This,
swipe
this
left and right.
lender's ugly. Swipe. This one's an ugly lender.
Yeah, but
Swipe.
they're putting up their deals, right? It's gonna be real estate related. I think they're eventually gonna update stuff to like, do other deals, but I believe, commercial deals on there, single family homes, fix and flips, like they're all on there. I checked it out. You can sign up for free. There's a free app, but obviously you can't really see, or you can't interact with the lenders if you have a free account, but you can see the deals that's on there that they've posted. So it's great resource. Cool. I think that's it, guys. If you guys are also wholesalers, help us find deals for the capital money, for the capital partners for Powerhouse. We are looking like in Texas. So I already have the buy box for you guys in that multifamily calculator on the reverse valuation page. So please send us deals if you guys have any. Just reach out to
Yeah,
us.
we're about to skip trace a large list of commercial leads in Texas, and I'm gonna put them on my CRM. So maybe somebody wants to come in and help me call them out, because I do a lot of the lead gen for basically everybody, or like acquisitions, and that's like one of my main positions here, because we all have positional roles to make things easy for us. We have a sponsor, we have a project manager, we have an underwriter, creative finance specialist. We have me, the acquisitions, and we have a short-term rental underwriter in there as well. So it's like we kind of line ourselves up so it's a little bit easy. We're all really busy, so it's kind of like we all put our time into the deal, which is nice while we're learning. And if anybody wants to learn, I'm going to be doing some live calls here soon once we get that list traced. And if anybody wants to jump in and help, like one person, maybe or two people want to help me call, obviously we'll compensate you on deals we buy. So, and that you're going to learn a lot too right there.
Oh, one last thing. I believe we're close to locking in a 75 unit for the Powerhouse Capital. So we will be, we haven't fully discussed it, but we're going to start raising capital for it. So if you guys are interested in multifamily home in Texas, we're about to lock one in. Hopefully soon. We should be finding out by this weekend.
Mm-hmm.
So reach out to myself or Carlos if you guys are interested. I believe we're going to more than likely look for accredited investors. So if you are accredited and want more details on that investment, once we have the investment summary completed, we'll be happy to send you guys the details on it.
Yeah, you guys are going to see us get to like 1,000 doors next year, just multifamily, not single family homes. So don't sleep. I already walked through coming up on the single family house side, still learning the game, right? I don't know too much. I'm just taking action, right? And then I have partners and people around me. We're about to do the same thing. I'm brand new to multifamily. Stan's way further than me. He's educating me. He's more of a mentor on this side of the thing than I am. And you guys are going to see me from the ground up. You're going to see us as a team from the ground up put shit together very quickly because we like to. Hopefully you guys catch on as well, right? Stay in proximity, stay learning. You guys are here every single day. What's going to happen if we continue to move forward and you're not doing anything? It's going to only make you feel worse because you're putting in the same time with us. I want you guys to succeed. You guys got to put the work in. Maybe calling if you guys are really just, need help just calling. That's why we're here. That's really why I have this powerhouse to show that. So I show you guys how to do it on single family. And as I get better, I'll show you guys how to do it on commercial. And somewhere down the road, Stan and I will probably create some crazy stuff, kind of like how we're creating crazy stuff right now for commercial. That's just we're like innovators at the same time as investors and entrepreneurs. Get fired up, guys. Does anybody have any other questions for Stan?
Don't forget the homework. Find a property you guys want to underwrite it yourselves so you guys can share. I want to evaluate how you guys deal next week. So, just find one property that you
Who's
guys are trying
who's
to
gonna
look at.
be finding us a property?
I have one in Houston. I was looking at
That's one right there. Okay.
Yeah.
Who else? Who else is working on it? All right. Let's say like Wednesday, Thursday, if you guys could either email or text Stan the information, put it on your to-do sheet, put it on a reminder. Let's get it.
Yeah. And then that's my number. It's on my signature. If you guys have Instagram, I just put my Instagram on there. Say hello. Don't be a stranger. If you guys have any questions, feel free to ask. The best way to reach me is typically my text, Facebook sometimes, but best way to get a hold of me is my phone number. If you guys have any questions.
Yeah, I signed up to that email list. Signed up to an email list. What's his name? Tyreek El Mosey. And he had a multi-family that he was blasting, I guess, on so that went to my email. I'm just gonna play around with the calculator with that there.
There you go. If you guys want some resource on YouTube, some guys that you should follow for commercial, Justin Kivel, his YouTube is Break Into CRE. He's got some really good content on there. I believe, who's the other guy, Carlos, that you have that book from? He has a really good channel. Oh, he's on the phone. But there's a lot of free content on YouTube, guys. If you guys want to learn how to get more basic underwriting, there's a lot of content on there. Just learn the terminologies at first, and just, it's not a race, right? Learning multifamily is definitely, it's complicated, but you're taking your next step in real estate. It's like the next level. So hope to do business with everyone. Hope to lock in some deals with you guys. But yeah, appreciate you guys all joining this Friday. You guys have a great, wonderful weekend.
All right, guys. Thank you so much. Tomorrow morning, 9 a.m., we're going to have the fitness twins come in and go over some stuff for the Powerhouse 75 Hard Challenge. Mark Chang at 1 p.m. We're going to pick a book. We're going to do the book club. He has a Google or like a Dropbox with a whole bunch of ebooks, so you guys can stay along. I mean, you guys can basically follow along. Basically, that's what I was trying to get to. You guys can follow on in the book, and then at the end of each chapter, you guys kind of discuss what you guys learned and whatnot. But I did a lot of reading, and I didn't have anybody to go over the chapters with me, so it's good to have different experienced people go over, hey, what did you get from this chapter? And so it's going to be something very good for you. Remember, I read a lot of books. Stan reads a lot of books. Why do you think we know more and more each month? If you find out that you're learning a little bit about wholesaling and you're learning how to come and do acquisitions, you still got to learn how to consume a lot of information as quick as possible. Reading will teach you discipline, and reading will teach you how to read very quickly, and you'll start to learn to consume it. Sometimes when you're not there and you're not focused, you'll read a chapter and forget the whole thing. So same thing, you got to learn to concentrate while you're reading the book as well. Try not to pick up your phone when you hear the phone ringing and texting. You're breaking up the way you study. Every time you get onto the next page after taking 10 minutes to respond to somebody you didn't even remember. So you have to learn how to teach yourself as well. When it's time to read, you put your phone away and you focus and concentrate. Otherwise, you'll never understand how to consume quick information, and that's what you need to do to be able to move forward very quickly. It's a valuable skill you guys need to learn. I learned it over time. Took me some time. I wasn't the best reader, still not, but that's why I had to separate some time before people are up trying to call me. I separate time, hour and a half to read, so then I don't have any disturbance throughout the day, so I can read peacefully. My phone's not blowing up. Then after I'm done reading, I get back to all the messages, or I try to get back to all the messages from the day or two before. But that's some advice for you guys.
Thank you, guys.
Appreciate it.
Much love, everybody. Tomorrow we'll see you guys. Okay.
Back at you.
Good night.